Okay, so today is Tuesday, April 8th. Last week tariffs came out. Thursday and Friday were not good days for the stock market. So, what did that mean though for interest rates? Where are we at today? And give us some guidance on how we navigate the waters of what's going on.
Yeah. Here's the thing, it's going to be hard because it was a wild roller coaster last week. When the stock market struggles, it's really good for interest rates, right? So suddenly rates start to plummet. And then what happens? Do you know what happened after that?
I don't. I was in Moab and completely checked out. So tell me what's going on.
It was like whiplash. Right? So the bond market, we get this massive improvement, and then like an hour and a half later, we lose all of those gains, right? So the problem that we're going to be in going forward is all of the things that are natural seesaws to interest rates, there's multiple of them going on at the same time. So it just depends on what everybody's paying attention to. If the stock market struggles, people move their money to mortgage bonds because it's more secure, which is great for interest rates. Having said that, we then have the Fed's looking at inflation because the tariffs, in theory, could cause inflation. And no one really knows yet, right? We haven't actually had it long enough to see what the impact is. So then the market swings the other way because they're like, well, if we get inflation, the Feds will raise rates, right? So that it's like we're in the worst possible playground where there's a seesaw competition going on, and it just depends on the moment who's winning. It's a little rough. This week we're watching job numbers, right? If jobs come in struggling, right? If unemployment is high this week, it is further sign of a recession. A recession is great for mortgage interest rates. Sucks for other things. Really good for us, right? It makes us kind of evil because we're like, look at those unemployment numbers. So it's going to be an interesting ride for a minute.
So we're seeing down, up, down, whatever, right? Mm-hmm. We don't really know, but how big are the swings?
Okay, on an extreme version, on an extreme day, say last Thursday, Friday, we saw roughly 3/8 of a swing in rate. That is a big swing. We don't typically see it move that fast, that far. Typically, what you see is a shift in pricing, right? So if you look at this, you notice that every week when we give you guys rates, we're giving you a par rate, meaning it's not costing any money to buy it down. We're giving you what can you get to on a rate with roughly half a point cost, and what can you get with a point in discount. Okay, that's what that chart is for. It's to show you where's the sweet spot in the market. Now, the swing in interest rates, when they happen, it's typically a swing to the cost, right? So you might have the exact same interest rate on a 30-year affordable. You might still be able to get 6.375, but instead of it costing a half, it's now costing 5/8 of a point, right? That is more normal swing day to day. We don't typically see it just completely wipe out rates. You will notice rates this week are very similar to where they were last week. So in spite of all the up and down, things are generally kind of stable, right? Every time we have a loss, we tend to get a gain that corrects it, and vice versa.
So really what I see from that, though, is rates are still in the 6s, mm-hmm. with the ability with certain programs to buy down into the 5s, mm-hmm. which historically is still
pretty great. Yeah.
And so there's a lot of things going on in the market right now that we're watching, right? But at the end of the day, like kind of where we're at is I don't know that things are really going to get any more affordable moving forward, because if we do see like stuff start to go down, look back to 2020. So that was the last time we saw these kind of losses in the stock market, mm-hmm. right? It was COVID. There was uncertainty. It was crazy. And what did housing prices do? They went through the roof. Like it did not make any sense. But what that has shown us is that people are honestly watching the interest rate. And as soon as that does come down, because I believe that they're going to continue to work on, they've issued the tariffs. I don't think that they'll pull back, but they do have the capability if they need to. Like if the economy is completely crashing, they could actually stop what caused this, right?
Right.
But overall, like we should see, like we probably will see interest rates come down because it is affecting the stock market. It is affecting the economy. They are going to have to watch stagflation because everyone that I've talked to has said with the tariffs, it's just going to be passed through to the consumers. I mean, the big corporations are still going to operate, but they are going to pass that down. So we may have stagflation. It'll be interesting to see, though, if their response to inflation, stagflation, is that they will go ahead and raise the interest rate, or if they'll do something else.
Right, and that is, that's why we say, like, who knows right now, right? I think some interesting lessons were learned during the pandemic because we lowered the rates so far that we actually created a lot of the problems we're having. I think the Fed's going to be really slow to come down too far.
Yeah.
Right?
Well, and I think we've seen it over the last year. I mean, it's just kind of been a game of hold. And really, I think we'll see a lot of the same of we are, depending on what's going in the market, we are going to see some swings up and down with the interest rate, but the overall, Fed rate, I'm assuming they'll pretty much hold, or it'll be maybe a quarter point or a half point, so it's not going to drastically swing anywhere. So at the end of it, I mean, I think it's still a great interest rate. I think we haven't seen a run on prices because there is uncertainty. And so, if we look at Warren Buffett, what he does, is he usually buys when no one else is buying. And so that is, I think right now, it's going to be a great opportunity. And when we look back 2-3 years, I do think people will be saying, man, I wish I would have bought then.
Well, that's always true, right? When people are like, when's the right time to buy? Well, it was like 5 years ago. And if you missed that, today is the right day to buy, right? So we are seeing it's getting much more active. A lot of people who've been sitting waiting are starting to see the writing on the wall. If they have been in this market previously, they understand that when rates fall, competition rises here. So a lot of people are getting off the fence and out shopping.
Yep. So again, Tuesday, April 8th, are we locking, holding? What are we doing with our buyers?
Okay. So here's one of the crazy things, and it won't work this way everywhere, but our team has the ability to lock and keep watching the market while we're under contract and move said lock. Not everybody can do that. But it's one of the reasons that we picked the model that we did is it gives us we can protect our client. So we are telling our clients we want you to lock right out the gate because then you know where your worst case is, right? Then you know it doesn't get worse than that. But we do have the ability, if the market swings and there's a good window, we can go lock it at a different bank and move our file around. So it's kind of a fun opportunity on our end.
So lock and then watch for better opportunity.
Lock and watch.
Okay. Anybody have any questions for Mandi today?
And just real quick regarding my question, I see that it's a 6.875%, so I'm throwing a Hail Mary here. Just say rates take a huge dip and they go down to 6.5 or even 6.25, but that rate lock and watch, will our clients have to pay to get that 6.5, or would you honor the new rate?
We would honor the new rate. So one of the beautiful things about our model is that we can lock with like 80 different banks. We are correspondent with many of them. So we can issue disclosures as a bank, right? Because we have our own warehouse line. We can issue the rates as us, but when we are locking, it's not like a typical bank. If you're in a bank model, they give you one rate sheet, and that's your rate sheet, right? And it's basically a blended version of all of the investors out there, all of the banks. In our world, we are choosing where a lock goes. So we can take and relock a fresh lock without penalizing that client and move the file. Now, this is important though. It takes a little bit of time to do that. So we are telling clients we have to make a final decision within 10 days of that closing because there are some disclosure pieces that have to shift. We have to transfer appraisals from one place to another, that sort of thing. So we say, like, you can't do it 2 days before closing, but still, we can, if you've got a 21, 30-day contract, we can lock it at the beginning to take protection, and we can watch and maneuver in their favor.
Senior Ken.
Well, so I Googled my answer. But my question was for everybody else, like, who actually appoints the chairman of the Fed? I honestly didn't know where that appointee comes from. And right now they're like, hey, we don't work for you, or this or that. Like, they're not necessarily working cohesively. So I was just curious where that next person.
And what is the answer? Because I don't know the true answer. I know that there's power plays going on in this scenario.
The president.
It is the president, okay. And he does have the ability to do so.
So
So
he nominates a candidate for the position, and then the Senate has to vote.
I mean, the Federal Housing Agency is another one that has massive impact to all of us. I don't know if you're watching that, but we have a new director of the Federal Housing Agency. And that is part of where, so I don't know if you guys have noticed this piece, right? We've had some changes in if you are not a U.S. citizen and you do not have a green card, things are getting really hard. They came out and said, we will not lend to anybody who doesn't have a green card. They took that back and they put it on hold, but stand by. I think that very well could be a thing, and I think a lot of the banks are already kind of getting sketchy about underwriting those. So that is something to watch. One of the things the Federal Housing Agency has said, the new director has said, hey, we don't like that policy was created that basically took from this group in order to help this group. We don't think that was right. So we're going to reverse some of those pieces. So back, a couple of years ago when they changed the loan level pricing adjustments, we're going to see them make some adjustments there that will make it'll make FHA financing more attractive for our clients who are under a 700. It'll fix a lot of things for our people who are 700 to 740 credit scores, because they've actually been a hard hit little group, believe it or not.
Okay. Shifting gears a little bit, is there anything we need to know or be aware of with changes with the CFPB?
I think things are going to get really lax. It's definitely, there's not a lot of funding. There's not going to be as many audits going on. You're going to see banks doing crazy things because they can, right? I don't know how far that pendulum is going to swing, but it's for sure going to swing, right? We went from like, hey, if you have a pulse, you can have a mortgage, to you have to fit in all those boxes, right? Hopefully they don't swing all the way back to if you have a pulse, you can have a mortgage, because that's what caused the housing crash, literally. Hopefully we don't go that far. But for sure, the CFPB, I would love to see a middle ground. That would be fun for a change. I'd like to see some common sense underwriting come out of that. But we will see some shifts there, because the police are being disbanded in a way,
Yep.
right?
Okay. That's what we got for today. Thank you.
Yeah, of course.